first, let's go back to the beginning of COVID-19 and how the market reacted. In the beginning, when first news of COVID-19 hit, it wasn't even called COVID-19. It was pretty much just some kind of a mass spread flu-like sickness that was going on in a part of rural China. The market went from its normal ticking year to date up to February was about 3%. The next phase was its massive downtick. It went 34% down from February 19th to March 23rd. The third phase, which is what kind of we're in right now, which is extreme price increase on the S&P 500. So let's break down further, see what was going on narratively in the economy and in the stock market during each of these phases. Well, in the first phase, most people didn't think it would affect us. A lot of the politicians said that it was a remote or a it wouldn't really hurt us here in the US and it wouldn't reach us, and it is a remote and minor detail. So the stock market chugged along as it normally would. In fact, COVID-19 didn't even get its name till February 11th when the World Health Organization christened it as COVID-19. Out here in America, we were thinking or talking about global warming, the impeachment trial. The coronavirus wasn't even on our radar. The second phase began on February 19th and went through March 23rd, where the stock market circuit breaker, which is the automatic stop button so that people stop selling, was pulled not once, not twice, not 3 times, but actually 4 times during that trading period. Now, what was it that changed the investors' thinking? Well, it was a whole constellation of narratives. Sadly, it started off as somewhat of a joke, but even out here in Hawaii, we had to call relatives just to get toilet paper. Then on March 11th, the World Health Organization finally dubbed COVID-19 as a global pandemic. People all over the world, Google gave us this data, showed that most people were typing in pandemic, coronavirus, COVID-19, just to do some research, just to figure out what is going on. Most people had no idea what a pandemic was, what it would do to the market, and pretty much did whatever they thought they should do based on what they could find research-wise, which brought back tons of narratives from the Spanish flu. Now, we're definitely not back then now, so how does it affect us 100 years later? People were still trying to figure that out. So then what happened on March 23rd or around that time to get the market to turn around? Well, the federal government, President Trump, signed in the CARES Act, which pumped in $2 trillion to the U.S. economy, or at least it promised that much money. Next, the Fed, the people who control the interest rate. So those of you folks who are like looking at houses now because the mortgage rates are down, you can thank those guys for that. But they said that they're going to keep interest rates at near zero and also not target inflation any higher over the next few years. So what that does is it allows business owners, you and I, to actually borrow money at a much lower discount rate so that we can go ahead and do things like business ventures, buy homes, and for businesses, take out loans to, create more infrastructure, expand. So then how does that affect us 6, 7, 8 months later in November with the market highs? We've had terrible time trying to get a second stimulus package set. We've had the elections. How is it that our market is still really high? In the US currently, we have over 200,000 cases per day. Is it the time to sell? Is it overvalued? Should I even start investing today? Well, there's this nifty graph I have here on the screen. It basically tells you that the PE ratio versus the actual price of the index has been severely non-correlational in the past and isn't really a good indicator, even though it is technically an indicator for price and for valuation. What is wrong? What's going on? Well, it begins with narratives, and there's a multitude of narratives out there, but today I'm going to go over basically just 2 of them, which I feel have a high amount of weight to why the index is so high and why people are saying that the stock market is so overvalued. Well, the first thing is investors believe that earnings will pick up. Earnings report were sent out with surprising results, which means that the economists and investment experts, their guidance was severely underestimated. So when they made estimates for quarter 2 and quarter 3 and quarter 4, as far as what they felt like the companies could hit, they were severely pessimistic. They thought the companies weren't going to make any money, and that they weren't going to do well at all. So what happens? The market prices that in. And today, because because the earnings were so much better than they had predicted, the market's going to get optimistic. Now, to solidify this confidence, take a look here at the estimated forward PE ratio. The current forward PE ratio for December is 39.28, and by December 2021, experts predict it to be closer to 24.19. This is public data. So by the end of 2021, investors believe that the S&P 500 will be properly priced if you bought it today, taking into consideration December 2021's 24.19 PE ratio. Which leads me to my second point on the earnings portion, is that if earnings increase and the price stays relatively the same, the PE ratio will decrease. So is that Shiller ratio, that 33.1, is that overvalued today? Well, of course it is, because the earnings are so deflated due to what's happening in the economy. In all the lockdowns, companies are making far less money than they were before. Airline industries aren't making pretty much any. They're just focusing on stopping the bleed. And again, all of this data, which is public information, has already been priced into the S&P's number. And I'm not going to go into it in this video, but market efficiency is something that most investors believe before going in to buying any kind of investment. And that basically, to sum it up, says that the market will always be efficient because everybody has the same data, everybody has the same predictions, everybody can run through the same models. So if the price is what it is today, it is because everyone agrees that it should be around this much. So the second narrative that's going around is that the federal government and the Fed is doing everything they can to try and keep the market from falling. So they'll have stimulus checks, they'll have stimulus packages, they'll help businesses recover. The Fed, with their zero interest loans, or the prime rate staying so low, pretty much encourages people to start again. So business-wise, that is what is driving a lot of this price uptick. Another thing to consider, and I don't really have this on my notes today, but consider that all of these, the S&P 500 is really only 500 of the companies, or 505 companies to be exact. And many of these companies are not, or are doing relatively well because of their relative size. Also, certain industries in the S&P, like the hospitality industry, the travel industry, have taken such a huge hit that the only reason the market's still up is because the S&P includes people like Microsoft, Apple, people who have, or companies who have large earnings even through this time. So it's not really a investment strategy, it's more of a reflection on how the US economy is doing. So if the US economy's earnings are predicted to be higher than expected, even with what's going on with the coronavirus, then the market is more of a true reflection on what the US economy is going to be moving forward. And that's pretty much, to sum it up, what the S&P 500 is meant to do anyway. So basically, don't look at the data for valuations. You have to take into consideration narratives that are going around, especially in the market where the data is empirical. So it's not like a science like physics. We can't depend on one particular ratio or one particular report to give us the whole story that's going to definitively happen. And lastly, my recommendation to you guys is to always review your goals and your risk tolerance, because those are going to guide your investment choices. Most times, people who are investing, especially on this channel, for the future, long term, things like this are mainly just a cautionary tale to people to always stay invested long term if that's your goal. As you can see on this chart here, the S&P 500 historical return results, what this kind of gives us is a snapshot of the S&P 500 adjusted for inflation with the dividends you're invested. We find that over these investment periods, 40 years, 30 years, 20 years, 10, 5, and 1, the average return rates the median, maximum, minimum, and the standard deviation. So as you can see, as a 40-year investment period, this is not from 1960 to 2000 or 1980 to 2020. This is basically all the different kinds of periods. 40 years sequentially, they calculate the average return is 6.494. The maximum return is 10.28. Minimum return is 3.187. Now we go all the way back down to 1 year. You have a higher average return, a much higher maximum return, much lower minimum return, and a higher standard deviation. So as you can see, as you invest longer, you're going to have potentially less returns, but a much more stable overall return. And let's go a little bit lower. You can see the percentage beating annual return over periods. So if you have a 40-year length of investment, you have a 90% chance of getting at least 4.906. All the way down here, 40 years, you have a 10% chance of beating 8.25%. So for long-term investors, for retirement planning investing, this is kind of your chart to look at. So if you got 40 years left, you can expect these kinds of returns if you use the US growth as your investment strategy. If you have 10 years left, here we go here. If you're only investing 1 year out, this is where more of your, speculative investing comes in, where you're not really investing for the long term. You're more investing for, quick gain. As you can see here, maximum 150%. And on the, low risk side or high risk side, you have a negative 58%. So you're working with quite a spread there and quite some risk, right? High risk, high reward. We go down here, very low risk, not so bad reward, 10%, but that's where the kind of methodology comes in for us long-term investors. Quick tip: one way to see how any particular investment is going to perform during a crisis is to actually look at how it performed in other crises. And how would you do that? Well, you look to things, metrics like this. Number one, the max drawdown. Number two, the max drawdown begin and end date, the max drawdown length, and the max drawdown recovery date. For example, you see how long it took to break even and how far it went down. Another key performance metric that I like to look at is what's called the upside capture, downside capture, and then lastly the beta, which basically tells us how much of a crazy ride we're going to go through by investing in this particular investment. So my two final thoughts on, is the market too high? Well, I would just like to remind you folks that again, the S&P 500 is not an investment strategy or retirement strategy. It is merely a guide or a reflection on the US market. And secondly, always keep in mind or pay attention to your risk tolerance and investment horizon. If you need something to be invested today to make you money tomorrow, you should just go to work. If you want something that's going to invest today and give you great chance for growth in the future, 10, 20, 30, 40 years, remember that chart that I just showed you, that one will give you a good gauge to what you can expect to return or expect as return in the S&P 500. So it just gives you a good gauge on the US market and how those markets have performed over a long period of time. Well, I hope that helps you guys today understand the math of the markets. Not so straightforward, never so clear cut, and I'll see you in the next video.